pleasure to introduce our next speaker on strategic investments in the market, various different market sectors. So he, by profession, is an actuary and originally started his career at Provident Life, moved on to Old Mutual, and is currently an investment director at London and Capital. So please can I ask Ashok Shah to come on board, and can we give him a warm welcome? So the question that we want to pose to you is that we've just won the lottery for $1 million. Where do we invest and how can we maximize our returns? So if you can give us a bit of an oversight in terms of the strategic investment in various market sectors, please. Thank you.
Well, thank you very much. It's an honor to be here to present to all of you. The question asked is, of course, fairly simple, but underneath actually is quite complicated because you need to look at the investors' risk appetite, time horizon, liquidity preferences, and many more things like that. I think that in order to probably do it a bit more concretely and probably for larger amounts to be invested, what I want to do is to take you through some very brief slides which will give you the background to the current financial conditions globally and in terms of where the opportunity set lies and what the threats are as well. So what I want to do is really start this presentation by the headline, which is removing the punch bowl. The punch bowl in this case really is the massive amount of liquidity that the central bankers are still injecting into the global money system, and that really has gone all over the world and it's basically ended up all in the risk markets everywhere. And what we are now in a situation is that markets have been running now for almost 8-9 years uninterrupted with hardly any major correction. And the question that's asked is, are the risk markets very overvalued? So that when you come to do your asset allocation, how concerned should you be about the current level of the markets? I'm going to cover the following points fairly quickly, and then I'll have some Q&A session because I'm sure you've got a lot of questions that you want to ask. So I want to talk about where the global economy is going, and I also want to then concentrate a bit more on what the Fed has done to date and what it's likely to do over the next couple of years. And I also want to touch briefly on Europe because it's quite important and it's now probably the fastest growing part of the world as well. And then I want to simply concentrate on what I think are the major risks out there. And then we'll end up with, what kind of portfolio one should have depending on your time horizon and risk profile. So I start with this very simple kind of diagram, schematic, showing you in a sterilized economic cycle, business cycle, where US and where Europe are. So all of you, I'm sure, remember that in 2008, 7 and 8, we had the financial crisis and the world slipped into recession. And then after a massive action that was undertaken by the central bankers around the world, and of course the governments in the major countries running some massive counter-cyclical policies, a recovery was engineered. And we've now been recovering for almost 9 years. And so in terms of where the US is, the way to think about it is we are in the very late stage of the economic cycle, business cycle in the US. And everything that the Fed has done to date has been to expand that economic cycle a little longer. And there are some very sound reasons other than politics why the economic cycle is getting extended. And I'll come to that point a little bit later on. And in case of Europe, Europe is basically 3 years behind or 4 years behind the US in terms of the economic cycle. And the underlying reason is that the ECB was that much later in coming to the aid of the economy. But effectively, the way to think about it is that US is in the very, very late stage of the economic cycle. And in terms of managing a portfolio, in terms of managing the risk, you have maximum risk, exposed to risk, maximum risk in your portfolio as you come out of a recession, because there the blood is on the streets, the asset prices are marked down significantly, the earnings power is lost, so effectively you're buying things as if they are bankrupt. And as you go through the cycle, once you are halfway through the cycle, you steadily but very gently begin to reduce risk. But most investors actually do pro-cyclical. So they will be piling on a lot of risk because they will look at the last few years and say, if the going has been very good, returns have been very high, and they keep chasing the returns. So instead of reducing risk, they actually will be adding a lot more risk in. So typically in case of the US, one should be thinking at the margin of, on a regular basis, taking some chips off the table and becoming more defensive. For Europe, you're halfway, so it's probably still early days to be taking risk of the European exposure. So in terms of, where are we, the world as a whole now, this year is slightly better than last year, maybe 0.1%, 0.2% in terms of the growth. So we are in a fairly good, stable growth economic environment. It's a steady as we go state. And of course, the amount of help that has been put on the table still remains enormous to promote the economic growth rate. You can see that also there's a good uptick in the emerging markets across the board. There's some solid recoveries going on. And I'll look at that a little bit later on, where those recoveries are taking place. Now, as always, one should keep an eye on where are the inflation rates going, because eventually the interest rates will respond to the inflation with a lag of maybe 1, 2, or 3 years. And all over the world, the large central bankers have a target of 2% inflation, and they have been struggling really to get to that 2% for a long time. And we can see that in the very short term, it's only basically the US where the core is around 2%, but it's already beginning to come back a little bit. So despite us being so late in the economic cycle with such large recoveries, the inflation rate really is not really picking up. So why is the inflation rate not picking up? So if you look at the drivers for inflation, you have structural drivers like wages, which are not really growing that rapidly, and I'll talk a lot more about that in the next few slides. But you look at more cyclical pushes on inflation, like the commodity prices, oil prices, and they normally come in, they wash out after 1 year. So again, there is very little impetus coming from the commodity cycle, energy cycle. So effectively, the real driver for medium-term inflation ends up being wages. And when you look at what's happening there, you can see that the nominal wages here, are really not going very fast in a hurry. It's the red line, which is the US, which is very late in the economic cycle. And typically at this point in the cycle, a lot of employment has been created, so there is tightness appearing in the labor market, and the pricing power moves to the labor force from the companies. But even now, that is really not happening. And in case of UK and Europe, there are no significant wage pressures. So that means that the underlying inflationary pressures are still pretty much absent. And, this is very unusual. If you look at half a dozen of the last few economic cycles, this is very unusual because it is this point when inflation picks up, interest rates begin to go up, and all the risk markets begin to correct. That is not happening. So the world is now changing quite quickly, quite dramatically. And the last presentation actually touched on it quite nicely. But let's just go a bit more into detail of why wages are not rising and therefore why inflation is not rising. Over the last 20 years, what this chart is showing you is that the middle skills around the world are getting destroyed. Jobs are being lost at a very, very rapid pace in the middle skill level. The only place that jobs are really getting created is in the very, very high skill set or incredibly low skill set right now. So this means that the people who are losing these jobs in the middle skills are having to reprice themselves, believe it or not, into lower skilled jobs at lower wages. And that then puts pressure on the lower skill set as well. So effectively what people are doing is they're taking jobs where they're twice as qualified because there is nowhere else they can go. And so you have what is called a deflationary cycle in wages going on. And this has been going on for 20 years as automation takes over, robotics takes over. So let's look around the world as well in terms of different kinds of areas of employment where this is happening. And again, you can see from this chart that, an awful lot of industries are going through exactly the same kind of restructuring. We talked a lot about the last one, which was the fintech and the finance. And there, jobs are getting lost, but new ones are being created on a very high level only. And I think this trend is going to probably accelerate, and we are going to go into virtual banks, over the next 10 years. So, this is still not yet finished. And this is the underlying reasons why we don't have wage pressures, we don't have inflation pressures. Therefore, there is no need for the interest rates to move up. And this is why the risk markets continue to remain in a fairly low risk, low volatile phase, even though they are expensive. So let's look at basically the US economy and what the Fed is saying. What the blue dots are showing you are the expectation from the FOMC. So this is the Fed individual governors' estimates of where they expect the Fed rate to be over the next few years. And the blue triangles are what the market is pricing in on a forward basis. So the market does not believe that the Fed can raise the rates like it wants to. And this has been the case for the last 4 or 5 years. So the market continues to be incredibly pessimistic about the ability for Fed to tighten meaningfully. And again, it's to do with the fact that there are no real inflationary pressures in the system. And if Fed was to tighten, then inflation will probably go to 0%. And when we were in the crisis, the biggest risk was actually deflation, prices falling, because the demand was falling away so quickly as unemployment had gone through the roof. So why are we in a world of incredibly low interest rates? And so what this chart is looking at really is, in case on the left-hand side, what it's showing you is that when we got into the crisis in 2008 and 9, the central bankers started to print an awful lot of money because interest rates were already very close to zero. And they did not want to go into negative nominal interest rates. So the only way they could change the cost of capital in the system was to basically flood the global system with money. And when you convert the amount of money they had flooded into an implied interest rate, you end up with something called the shadow bank rate. So that's the equivalent impact on the short-term interest rate. And what we saw was about 3 or 4 years ago, the US was running, which is the dark blue line, and UK, which is the light blue line. So we were running the system at around minus 6% in terms of implied interest rate. So that's the amount of help that was put on the table to engineer the economic recovery. And you can see the yellow line, which is basically the Eurozone repo rate, which is the ECB benchmark rate. Until a few quarters ago, they were running that rate at minus 8%. Which is why Europe is at last recovering. That's the amount of help that they had to put on the table. And remember, most of Europe is still in a negative interest rate scenario, negative nominal interest rate scenario. So effectively, they are having to run interest rates incredibly low to generate the type of economic recovery we are seeing. And the best we can do for the developed world after this much help is try and get back to 2% growth rate, which is quite low when you think about the amount of help that is being put on table. So you can see that the world is incredibly fragile if you're having to push it this hard and you get so little growth. What the right-hand side is showing you is how the QE actually works through the system. What it does is that it collapses the cost of funds for the household, for the corporates. And effectively, by collapsing the cost of capital, what you do is you reliquify the household balances and the corporate balances. So in other words, as the loans mature, instead of paying 4%, you end up paying 2%. So you need half the cash flow to make sure you don't default. And of course, all of this goes back into who lent the money, and of course, it's the banking sector. So the collapsing the interest rate, the biggest beneficiary is initially the banking sector. And the idea is that the banks were in distress, they were pretty much bankrupt. And the way to reliquify and get them to recover is to change the value of the collateral in the bank balance sheet. And the way you change the value of the collateral is to make sure that they are not non-performing assets, but they become performing assets by doing this. So this effectively means that unless you can kickstart the banking sector, you will not be able to kickstart the economy in the long run, because the economy requires access to loans to grow. And most of the loans in Europe comes from the banking sector. In Europe, 80% of the credit is supplied by the banking sector. In the US, only 20% comes from the banking sector. So the European banking system is far more important to Europe And so all of this is to engineer a recovery in the European banks, which in turn makes the economic recovery more sustainable. So this is probably one of the most important slides. What the left-hand chart is showing you is of the major banks out there: the Swiss National Bank, Bank of England, Bank of Japan, People's Bank of China, European Central Bank, and the Federal Reserve Bank. This is their central bank balance sheets in aggregate. And you can see that they started to expand their balances, effectively inject enormous amount of liquidity into the global financial system. And right now, the total balance sheets of these banks is running at 40% of the world GDP. So this is enormous, has never happened in peacetime before. And really, effectively, the basic rules of the economics are very simple. If you have too much of something, the price of something goes down dramatically. And so the price of money, which is cost of borrowing or cost of renting or cost of hiring, goes down dramatically. And this is why we remain in a world of zero interest rate. There is too much money out there. And the money needs to go somewhere. And the money eventually ends up in all risk markets around the world. It just cascades. So all financial markets are connected because money knows no boundaries. So we are now in a world which is full of liquidity. The liquidity is now sitting in financial assets because it's like a reservoir, it's like a dam. And the financial market just absorbs whatever liquidity you can throw at. Simply the price goes up to absorb it. And so where we find ourselves is that all risk markets technically are very expensive. But not only are the risk markets expensive, even what you would think are incredibly low risk markets, like the government bonds in the mature countries, are also very expensive because that central bank balance sheet, large part of it was used to buy government bonds. So you had a set of buyers who were price insensitive, were driven by politics and by social objectives, and which meant that they kept buying government bonds, driving the price up, driving the yields down. So actually owning government bonds in the developed country could be, instead of the lowest risk asset, could actually end up being the highest risk asset on a longer term basis. Not necessarily on a short term basis, because you need them to change their balance sheets and for them not to hold the government securities for the right price to be found in the market. So what this is trying to tell us is that the clearing prices of risk markets are artificially high, and they are being managed by the central banks. They are not necessarily being set by the marketplace between willing buyers and willing sellers. So we are in a fixed game, and we need to understand the rules of that game before we really engage seriously on how we're going to manage our money. What the right-hand side is trying to show you is that 2 weeks ago, the Federal Reserve Bank announced that it was going to start contracting its balance sheet very slowly, very gently, over a very prolonged period of time. And so as of now, we still have the European Central Bank, Bank of Japan, and Bank of England still printing a lot of new liquidity. So there's a lot of new liquidity still being injected into the global system, which is driving the risk market, which is why when you look at S&P 500 or NASDAQ, why they make new highs. Because new money is thrown into the global system, it ends up in financial markets. But what the dark line is trying to show you is that it's probably going to be into 2019 before, on a net basis, the central bankers don't buy any more assets. So you have a set of buyers who are price insensitive, driven by social and political objectives, right now functioning in the marketplace. And they'll become, as the quarters go by, a year from now, maybe 2 years from now, significantly less of a force, and then the market will have to re-equilibrate and find the correct clearing prices for all risk markets. If you were to take one chart away with you to think about, over the winter when it's dark outside, it is this chart here. What the shaded blue part is showing you, this is at the global level, not any one country, it's the whole world together, and it's looking at the total indebtedness So that's the government sector, household sector, and the private corporate sector. And you can see that it's just going through the roof. And we got into the crisis of 2007 and 8 because the system was too leveraged, and we had the collapse. And far from deleveraging, we have continued to leverage even further. And if you look at the two lines, the yellow line and the red line, they are really cost of capital. The yellow line is the real short-term world interest rate in aggregate, allowing for inflation, and it's barely above zero. So the cost of capital in real terms for the whole of the global system is being set at 0% roughly. But more important is the red line. The red line really is the 10-year forward real interest rate. So it's nominal interest rate 10-year forward, adjusted for the forward 10-year expected inflation rate. And we are setting at the global level a clearing rate of minus almost 1 and a bit percent. So just imagine what this means. Technically, the borrowers are being forced to borrow even if they did not want to borrow, which is why the blue line is going up. Everybody out there in the wide world is optimizing their balance sheets, and effectively that means that those who have the capacity to borrow are still borrowing. So this is like a chicken and egg. If interest rates go up, we know that the debt cannot be serviced and you will have a massive non-performing and loans and bankruptcies. But the longer we keep the interest rates at this very low levels, negative levels, more the borrowing is being encouraged. So it's like a catch-22. If the central bankers were to raise the cost of capital, then they will create a default cycle and it will cascade into a massive recession down the line. So one really simple comment to think about is that in the last couple of economic cycles, you would have corrected your excesses by going from 5% to say 6%. So for new borrowing, that's 1% on 5% extra, 20% increase in cost of capital. Today, you go from 1% to 2%. It's a 100% increase in your interest outflow on new borrowing. So that's 5 times interest rate sensitive at this point in time, just on interest rate. And we got 25% more debt now than the last cycle. So we are now 7 or 8 times as interest rate sensitive as we were in the last couple of cycles. So when they said that the interest rates are going up by 0.25%, most people don't understand. 0.25% translates into like a 2% in the last couple of cycles. So if you had 3 or 4 quarter-point rises, you're talking about 5 or 6% increase in cost of capital. That is the economic sensitivity. That is how sensitive the world has now become to interest rates. And this is where the possibility of a policy mistake comes to mind, and the whole mountain is going to crash. So the latent risk in the global system, the tail risk in the global system, continues to rise quite dramatically. But of course, it might not mature for a while until the central bankers make a policy mistake. I know there are a lot of slides, and I'm sure that many of you want to ask some questions, so I'm going to try and rush to a couple of the slides, and I'll only do 2 more slides. I want to just focus on this right-hand slide, and what this is looking at is the real interest rates that are needed to keep the economy in a stable state, in an equilibrium state, and where we actually are. So we are, in most of the developed countries, a long way from where we should be. So we remain still in a very loose monetary environment 9 years into the economic cycle. The world needs that amount of help. The other way to think about it is the subsidy from savers to borrowers to keep the world stable. That's measuring that, roughly speaking. So the world is incredibly fragile this late into the economic cycle, and that's a very, very big cause for concern. There are a lot of reasons why this is the case, but I don't have time to go into right now. What I want to do is, I'll just talk about this slide because there's India, and there are a lot of people who come from India, I think. So what we have seen there is the Indian growth rate is really pretty much steady state around 6%. And I think it's just going to continue like that. And once the reforms have worked through, and that might be 3 to 5 years, we can go into 8 or 9% growth trajectory. But that's once the bottlenecks in the system have been resolved, which are infrastructure and the transmission of the money mechanism in India is not working. The flow of the loans are not working because the state balance sheet, the state bank balance sheets are loaded with non-performing loans which have not been cleared. So they cannot expand their balance sheet to lend the economy to grow. So until they have fixed that problem properly, India cannot get into 9% growth rate. So they need to fix the banking system first, and then need to fix the infrastructure second, and then you will be in a growth state. But the bottom right one is really very important. You can again see that even the emerging economies, which were normally typically in a high inflation area, the inflation rates are all coming down quite quickly, and I expect that trend to continue for some time to come. So we are genuine in a low inflation and interest rates world also in the emerging economies. And of course, this then translates into cost of capital, which will continue to come down. So the question that was asked is, how should we position a portfolio? And the example given was just $1 million or pounds or whatever. Of course, you can't construct a properly diversified portfolio with £1 million unless you end up buying collectives. So I'll just leave the quantum alone, but just talk about this. What this is showing you is that if you were trying to get a nominal return of 7.5% through the years, then what asset mix you probably needed to put in the portfolio to generate that. So a long time ago, you could just buy bonds and just leave it at that and you are fine. Today, we are far from that. Now we are forced to go into quite small and fringe markets, illiquid markets, so whether it's real estate or private equity, so you are sacrificing a lot of liquidity to generate returns. You're having to go into small caps, by definition, very high risk. So effectively, to generate the 7.5% return stream, you're having to have a very, very risky portfolio. And a way to understand how risky it is, just look at the last line, it's like a standard deviation, which is basically, to understand what that is that once in, say, every 10 years, you might see a mark-to-market downside in your portfolio, say 2 times that. So that kind of asset allocation, you should only have if you're able to stomach a 35% mark-to-market loss in your portfolio. So most people will not be able to do that. So what we are saying is that people are out there chasing risk to get the returns that they've been used to. And we're saying walk away from that. That is not the way to do it. You should be de-risking your portfolio as it's getting very late in the economic cycle. And when the cycle ends, it ends very, very quickly. And you don't have a lot of time. When it ends, it goes very, very fast. And it's like being in a crowded cinema and everybody wants to go for the door at the same time. And of course, nobody can leave and everybody gets the bloodbath. So it's getting very late in the day to be increasing risk or run very risky portfolios. So our kind of advice for conservative portfolios is basically have a very large allocation to fixed income securities, and your equity allocation should really be restricted to what I would say are very strong companies. So companies with low debt to equity, companies generating very high free cash flow to pay dividend streams which are going to be rising. So it's a very much an income-seeking portfolio in a world of low interest rates, which looks like we are embedded in that world for some time to come. So I'm going to leave it at that because I know it's a lot to digest. A lot of ground has been covered, but more than happy to take a couple of questions.
Thank you very much, and we'll have time for 3 questions. So can we get a mic here, please?
You have shown the economic cycle, ups and downs. I would like to know, when do you expect recession in China?
Oh, wonderful. Actually, I just came back from China about 10 days ago. I was there for 3 weeks touring as a tourist, actually, not on a business, across a wide spectrum of China. And first of all, what I would say is that it's not a developing country. It's actually developed from the infrastructure and everything else. It's incredibly efficient and it works very well. Of course, politics is a different question and so on, and the political system. But coming back to, when are we going to see a recession in China? My answer to that is that you're not going to see it in our lifetime, because simply they have a lot of room to maneuver. They have a lot of room to maneuver in terms of expanding the bank balance sheet at the central bank level. They have a lot of room to cut interest rates. The interest rates can still be cut by 3–4%, and they will have room to inject awful lot of liquidity when the time comes if it's needed. The domestic component of the economy is only now getting revved up. So if you look at the composition of the Chinese economy, the consumption 20 years ago was probably 45%, and it's now about 37%. So it's the export and the manufacturing that has been running China for the last 20 years. And they are very slowly but steadily converting that into much more of a domestic machine, much more of domestic financial services, domestic consumption cycles and all of that. So they have all of that to exploit over the next 10, 20, 30 years. So I think that if you were waiting for a Chinese recession, it'd be a very, very long wait. It's not going to come in our lifetime. The key question about the recession, because it's connected to it, really is that every time there is a slowdown in the business cycle, economic cycle, those who are swimming naked are found out. What that means is that those who have invested money badly basically end up defaulting on their debt. And we already know that the Chinese banking system, just like the Indian banking system, contains a lot of undeclared non-performing loans. But it's not a global issue, it's a much more Chinese issue, it's containable, and you should, from an external point of view, not worry about it. And the reason is that just like in 2007 and 2008, in the developed countries, the bad loans from the banking sector were migrated onto the government balance sheet. Exactly the same thing will happen to China. So the central government debt to GDP, which is now running around 40% plus minus, on a see-through basis is probably 65% if you assume all the loans are migrated. So they are not in any stress, even if the loans are truly migrated and disclosed.
I think there was a question at the back.
Yeah. Ashok Bhai, Kem Cho. Two quick questions. Now, you said we are very late in the economic cycle. Could it be the case that we are at a period of history, like the Industrial Revolution, where it is a very extended upswing economic cycle? So that is the first question. The second question is that here in this room, we are very interested how to make money on the Mumbai Sensex. And maybe you can recommend some sectors we can invest. Thank you.
Okay, two very interesting questions. So the first one, as I was saying, the actions that have been taken by the main central bankers for now has really been to extend this current economic cycle. So why are they doing that? And to understand what is happening, you have to go back to the end of the last economic cycle. Effectively, the developed OECD banking system was bankrupt, and it had to be reset and re-equilibrated. So we moved from Basel II to Basel III regulations, which have now been superseded by Basel IV. Originally, the Basel III was supposed to end in 2019, and it was really designed to tackle too big to fail. In other words, the banking system globally, the globally systemically important banks and financial institutions which were listed by the Bank of International Settlement were then given a timetable until 2019 to restore their balance sheet so that in the next recession, the taxpayers would not bail them out. So they would have strength to absorb a non-performing loan cycle. So we are still not in 2019, but that 2019 has now been superseded by Basel IV regulation, which takes us to 2022. When the system will be properly deleveraged and the banks will be able to absorb a default cycle. So every recession brings forward a default cycle, which then the banks have to effectively end up taking into their balance sheet, and therefore their core tier 1 and core tier 2 equity gets wiped out and they have to be reliquified. So the central bankers, in a way, are waiting to make sure that the global banking system is fully recapitalized so that the call on the taxpayers is avoided, so politically it becomes a lot less explosive than last time. So in terms of, if you looked at that economic cycle, and I can kind of go to 1850, there are 33 economic cycles, and this is in the top 3 or top 5 already. and we're going to extend it by another 2, maybe 3 years. We have not abolished economic cycles. It's just that every cycle is slightly different from the last one. And I was trying to give you in some of the slides earlier why the cycle is getting extended. The cycle is getting extended because inflation remains dormant. Inflation remains dormant because the robotics and IT and the way we do things is changing dramatically. You know, we are bringing in hidden latent capacity into the world market. Think of what Airbnb is doing. If you have a spare bedroom, it was not contained in unused capital assets, but it's coming into the marketplace, driving the price down. Same thing with the Uber or whatever. So we are bringing in a lot of latent capacity, which was never measured as excess capacity, into the global system. And that is putting the lower pricing pressure. And that is allowing the cycle to be extended. But eventually, extending the cycle creates its own excesses. And the chart I was trying to show you about, the one chart to take home, is that the global level of indebtedness is rising quite quickly still. And when interest rates moved up even a tiny bit, then the after effect of ending of this economic cycle will be far more disastrous than the previous cycles. Now, in case of your second question, I mean, we know that India, like other emerging markets, you know, it's the consumer side of the sector, it's the export, it's the software side, it's the IT side, where the really big return on capital are to be had, or new markets will open up. The consumption cycles in all of these countries are in their infancy simply because the number of people employed still will be rising quite quickly, and then after a while their real earnings power will be rising as well. So really it's to do with servicing of the consumption base, which is where the big longer term opportunities are. And of course in this is included housing and so on. But of course I think real opportunities will come when India begins to liberalize both its services sector, financial services and so on. But that may be a very long wait. I think that in terms of investing in Indian infrastructure, again, they made it incredibly hard for foreigners to really incise invest in those kind of sectors. I would say that some of the bigger companies, whether it's in the IT sector or in pharmaceuticals, I think they are not really world-class at the global level. They are really not that competitive. You know, on the pharmaceuticals, the older companies, I think, forget it. You want to go to the biotechs, new ones. But as always, like the previous slide, speaker's slide showed, what you buy in the fast-growing sector is not the people at the forefront. You buy the guys who make picks and shovels. You do not buy a gold miner. You buy guys who equip the gold miner, and you'll make a lot more money that way. And I think that remains the key even in the Indian market.
One last question.
Sorry.
Yeah, my question is, don't you think that the economic cycle in US will get extended with the protectionism that the Trump government is getting in and the feel-good factor that is already there? Economy is definitely on the upswing there. So would that not be extended? And the second question is, when can we see interest rates near the levels that we see in the Western world in India? Do you think that could ever happen?
That's there are quite a few questions. I'll handle two. One is Trump and whether it's going to extend the economic cycle. I mean, that's how he got into the office, by promising to do a lot of fiscal spending. And of course, very little of that has happened. And it's unlikely that much of the legislation that he wants to pass is going to be passed. It's all delayed and getting delayed even further. Changes to Obamacare and so on are really not happening that quickly. I think rather than worry too much about the fiscal boost at the end of the economic cycle, the fiscal spending boosts are most effective when you're coming out of the recession, least effective at the mature phase of the economic cycle. The multiplier that you get is a lot smaller at the mature phase of an economic cycle. You don't get your bang for your buck, basically. But the cycle will be extended as long as the Fed does not overkill it, rather than politicians deciding to go on a spending spree. And the Fed is acutely aware that it doesn't want to end the economic cycle in a hurry. And if you look at the last two statements that came out, in between long kind of question and answer sessions, what they said is that if the conditions warrants it, they will expand the balance sheet again. So even though they announce the contraction of balance sheet, which is another form of tightening, they put a caveat that if things get really bad, we will reverse our policies, which is how you extend the cycle. Now, your second question is probably far more interesting. At what stage will we see interest rates in India match those of the mature countries? And I think that the demonetization probably was the key, because what demonetization does effectively is that it changes the government finances 5 and 10 years down the line, because the government will be able to collect taxes to finance its expenditure rather than relying on central bank to fund its bond purchases, which ends up resulting in inflation. So the key is what will make the Indian inflation rate go down for good and stay down. And that is a gradual liberalization, which is already taking place, more of that. But more importantly, one of the big drivers of the Indian inflation, persistent driver, has been that many of the key prices, whether it was the fertilizer prices or electricity prices or whatever, because they had been subsidized for so long, it was a slow journey to get them to market rates. And if you don't get them to market rates, you cannot attract private capital into those subsectors in the infrastructure. But getting to the market level meant that all of that fed into inflation. We've already been on that journey for almost 10 years, and maybe there's another 5 years of that left. Once the price of all the utilities become at market level, then inflation rate will collapse, because government is no longer printing money to finance its budget deficits, because it's collecting enough taxes in a few years' time, because the whole economy is now kind of IT, electronically, you can track everything right now. So there are very important things in the pipeline. Results of that will be seen in 5 years' time. And so I expect at that point in time, the interest rates in India will collapse, so your 10-year bonds will go to 3%.
Thank you very much. Thank you. Please. Can I call upon Nilesh Joshi, CEO of Joshi Group from Nairobi, to give a little memento to Ashok Shah. Thank you. And just before break, can I call upon Sanjay Lodha to please come on stage?